Well, I'll tell you what, I'm going to go ahead and get started, guys. So first of all, thanks for everyone for joining us. And there's still some folks trickling in. So if you guys missed something, we're going to have an opportunity to have a recording for this as well. But ultimately, welcome and thanks for talking to us here at Foundation Wealth Partners about the Qualified Opportunity Zone investing. It's really a unique opportunity. And as your advisor or prospective advisor, one of the things we do at Foundation Wealth Partners is it's our duty, our responsibility to constantly be, navigating and understanding what's out there and what's available when it comes to, planning techniques and helping folks deal with things that come up in their lives. Taxes inevitably is one of those things that we're going to have to deal with, for the indefinitely. And there's with the tax code changing here recently, seems like every few years, there's quite a few things that are commonly overlooked, not understood, and things of that nature. And so one of the unique opportunities that's been around now since 2017 actually is the Qualified Opportunity Zone fund investing. And this is something that is becoming more and more prominent as we approach another potential substantial tax code change. One of the unique offerings with the Qualified Opportunity Zone is it enables us to defer capital gains tax through a type of real estate investment. And it's oftentimes kind of confused a little bit with the 1031 exchange. So we're going to talk about that today. But I think most importantly, there's a lot of different features to it that go above and beyond what a traditional 1031 exchange accomplishes, number one. And number two, which I think is even more exciting, is the Qualified Opportunity Zone investing is something that's not just for capital gains via the sale of real estate. It's actually something that we've used for folks selling a business, even appreciated assets through a stock portfolio. So it's really a unique tool, that can be, I think, if positioned correctly and understood, can be really, really valuable, in a collective investment portfolio. Today we have our guest, Matthew Hannon. Matthew's a Senior Vice President with Cantor Fitzgerald. Cantor is one of the world's, leading real estate investment firms. And I thought that, number one, we'll take a minute here to tell you a little bit about Cantor. But we've partnered with Cantor. They're one of our main providers or main sponsors for the Opportunity Zone fund investment that we use for a lot of reasons. But I think that it's important to understand a little bit about the firm that you're working with behind the scenes, a sponsor ultimately that'll be making the majority of the investment decisions with regard to the direct real estate investments in the fund. And also Matthew's going to kind of walk us through some of the ins and outs of how the Opportunity Zone fund investing works. I'm going to be riding alongside asking questions as he goes along, as I've talked with a lot of you. A lot of prospective clients and friends and family. There's a lot of what I call just kind of common questions that folks ask, and I'm going to be asking those to the best I can over the course of this. But if you have a question, please make a comment. We'll be looking at that as this goes on, and I'll do my best I can to get to it. So with that said, for a moment, I'm going to turn it over to Matthew. And Matthew, if you would, first of all, why don't you tell us a little bit about Cantor Fitzgerald and kind of how you guys fit in? Just a high level view of you guys' background and everything like that.
Sure, Brian. And first, I'd like to say that to everyone, it's great that you have a fiduciary like Brian at Foundation Wealth Partners that's showing you proactive solutions versus just reactive services. So I work with the top advisors in Texas and a couple other states like Brian. And I feel like the advisor that's, proactive, looking for new ideas and ways to increase and preserve your wealth, I think adds the most value. So you're in good hands with Brian, whether this is appropriate, for your situation or not. If he's taking this much care in pre-tax, considerations, imagine all the care he's taking, with all the after-tax money. With qualified opportunity zones, like Brian said, it all came out in 2017 in the Tax Cuts and Jobs Act. And I'll get into a little bit about my firm, but bottom line, it's only for capital gains. So it's long-term and or short-term capital gains. So if you're in that position with substantial capital gains, congratulations on your successful capital event. or if you haven't realized them and they're sitting in appreciated assets, this is a solution that you may consider for even just a portion of your gains. And again, like Brian said, it's not just capital gains on real estate. It's literally capital gains on almost any appreciated asset. Most of who we help are someone who sold a business, real estate, concentrated stock, pool of stocks, but we also help somebody with a Star Wars collection. So literally almost any asset with a gain. Real quick, first and foremost, just need to read off these risk factors. I'm not a CPA. We do not give tax or financial advice. Please, go to your fiduciary like Brian for any financial advice, and your CPA and or his group for tax advice. We do provide CE credit for CPAs, so if you are a CPA, we can provide CE credit for this presentation. And then again, this is situational, not for the broad-based client, but it's for accredited investors with large capital events. There is illiquidity risk, which we'll get into, and obviously risk in any investments, especially and not excluding real estate. But we'll go over those as we go along. So real quick on Cantor Fitzgerald, and again, Brian's going to interrupt with any questions. He's already talked to most of you folks, so feel free, Brian, to interrupt me if anything comes up along. Keep it conversational. Sure. Cantor Fitzgerald's been around for 75 years. And I think what makes Cantor Fitzgerald a little unique is that during those 75 years, we've only had two CEOs running the company. Bernie Cantor, who founded the firm in 1945, and Howard Lutnick, who took over at age 29, if you can believe that, in 1991. And I think 2 days ago was his 60th birthday. So he's still a relatively young CEO. We are one of 24 primary dealers with the Fed. We're investment grade. We've got 12,000 plus employees. And in terms of real estate, we're the fourth largest commercial real estate firm in the United States. We just own a lot of different companies by different names and flagships like Newmark, Knight Frank, ARA, Cornish and Carey, Berkeley Point. And I think that is important, especially with qualified opportunity zones, a firm that has a long history and track record, been around through many economic cycles, and then also is a leader on the real estate side, especially with opportunity zones. We, instead of hiring local developers, we partnered in relation with qualified opportunity zones with a joint venture partner, 50-50, not a sub-advisor, with Silverstein Properties. They're a pure developer that redeveloped the World Trade Center. So again, you got two, in our case, two massive firms with long histories and pristine reputations in the qualified opportunity zone space. And we'll touch on tidbits about Cantor Fitzgerald and Silverstein as we come along, but these are large investment amounts. These are 10+ year horizon investments. You just want to make sure you deal with a company that's going to be around in 10 years. So I think as we go into the risk of the real estate, we feel that one of the biggest risks is who you partner with, the sponsor. Are they a great developer? Have they been around a long time? Do they have alignment with the shareholders? So we'll get into a little bit about that, but just wanted to briefly touch upon Cantor Fitzgerald as a sponsor.
Yeah, and I'll drop in real quick too, if it's all right, Matthew.
Sure.
I had the opportunity a week or so ago. I was at an event and got to chat with actually a smaller local Dallas-Fort Worth-based sponsor that does investment deals, multifamily and things of that nature. And one of the things I talked to them about was the qualified opportunity zone fund investing. And, kind of how their experiences was from a sponsor's perspective, putting one of those together. It's a really unique conversation. But at the end of the day, what I took away with was it's unlike any other real estate syndication. So if you've ever invested in a real estate syndication, the qualified opportunity zone, as you can imagine, because it's got a lot to do with federal taxes and special treatment, it's not easy from the sponsor's perspective. And so there's a lot of sponsors out there that do these qualified opportunity zone fund investments, and it's not easy. And so I actually wasn't aware of all of the intricacies that went into it, but it was really an eye-opening conversation for me to have, and really made me feel comfortable dealing with larger businesses that really have their act together and go at this with intention. So just to kind of echo and piggyback on what you said, I think that was a pretty interesting conversation.
Yeah, and the qualified opportunity zone, and we'll get into this, but in terms of a fund, it could be one project on the corner of your local, city, or it could be multiple projects across different states, and it could be Jimmy and a couple pickup trucks doing their $5 million OZ and hiring a local accountant and lawyer, or all the way to a Cantor Fitzgerald with a diversified portfolio using KPMG for accounting, Clifford Chance for legal. So, like to your point, Brian, there's a large spectrum of sponsors. We think it is the most important to go with a quality sponsor that's large and has shareholder alignment. So real quick on the qualified opportunity zone front, like Brian said, it started in 2017 in the Tax Cuts and Jobs Act. So it was bipartisan. They've been working on opportunity zones for decades now, and it at the time was its own bill. It had bipartisan support, 50 legislators on both sides of the aisle. And then when they were about to wrap up the 2017 Tax Cuts and Jobs Act, they put that bill inside of that legislation, and it was passed. So qualified opportunity zones, what are now QOZs, are set in stone. They're census tracts that are based on 2010 census data. And the whole idea behind the concept of qualified opportunity zones is to incentivize money that's sitting on the sidelines to invest into areas and communities that were left behind in the Great Recovery. So, and create construction jobs, retail jobs, and revitalize those neighborhoods. We at Cantor Fitzgerald and Silverstein Properties feel that you do not have to sacrifice, return to do good. We believe in doing good while doing well. So we are investing in pieces of real estate that we were excited about before any QOZ legislation. But we also give back to the community and have that kind of mantra of adding to the community as we develop. Some of our multifamily will have affordable living components, or we'll build a multifamily with a museum on the bottom, park around it. So Silverstein, our developer, has been doing QOZ type developments their whole 57 plus year record. They're not just building buildings, they're building the next live, work, and play atmosphere for the community. So that's kind of the side of it where we're also improving the community and creating jobs. Brian, did anybody have questions on that front?
Nope.
Okay, great. So what most people on the other side, I get questions asked all the time is, why throw good money at bad? Which again, everything is based on 2010 census data. So there's a lot of parts of the country that didn't make sense in 2010, but make sense today, regardless of any tax benefits. And that's where a lot of the large funds are focusing on, areas in the path of growth that have been growing for the past 7, 8, 9 years. On top of using those old 2010 census tracts metrics, the governor of each state got to choose 25% of those census tracts to be their qualified opportunity zones of their state. So if you're the governor of Texas, you're going to choose East Austin, downtown Deep Ellum, Medical District of Houston as your QOZs, because you're also competing for dollars all across the United States. You want, the money to flow into your state and further attract capital and further grow your developments in your cities versus all the money going to Arizona or Colorado. So again, we feel there's always risk in the piece of dirt, but most QOFs, they depend on the actual real estate. They don't chase tax benefits. And we'll get into those tax benefits, but bottom line, you're investing in real estate. The real estate has to make sense on its own, and that's where we're focused on. You know, not all OZs are created equal. So, you know, half of Alaska is an opportunity zone. You can build up here in Wyoming, but if nobody builds around you, how successful is that multifamily? You know, we believe in, you know, building in, let's say, East Austin, and right next door another developer is building, you know, a retail shopping center. So everyone piggybacks off each other and creates the next live, work, and play atmosphere and environment.
Matthew, what are some of the, so in your current qualified opportunity zone fund, where are some of the projects located? And, you know, if you don't, and or, you know, do you have your eye on any specific areas that you guys intend on starting a project? And
yeah,
then I guess, in addition to that, the one more part to it, typically how many projects are going to be, can a client, can an investor expect to have in their investment? How many different projects is that going to consist of?
Yeah, some QOFs are single projects, and we come out with sidecar single project QOFs as well. Those are typically K1 partnerships. Most, you know, QOZs are all over the country, so even if California were to not recognize QOZs, a development can happen there. It's just the citizens of that state do not get the state tax benefits, but somebody in Texas can invest anywhere across the country. We also have a flagship qualified opportunity zone fund that's a larger corporate structure that allows us to diversify and have projects in Philadelphia, Astoria, Queens, or, you know, downtown Las Vegas, and further diversify someone all in one QOF where they get one 1099 a year. So those are the two structures, typically partnership K1 structures or a large corporate structure that provides one 1099 a year.
So it's either, you know, a fund that's going to invest in one single project, and that's going to be potentially have a little bit more tax complications to it, for better, for worse, or a fund of what, 3 to 5 individual projects that are, you know, potentially going to be diversified across maybe a handful of states.
Exactly.
And in that option, investor is going to receive one simplified 1099 as opposed to a K1.
Exactly. Yep.
Gotcha. Okay.
And this slide just kind of backs up what we were saying, that, you know, we own Newmark Knight Research, and we look back at every zone that is now a QOZ, and 3 years prior to the legislation, 50 billion was pouring into what are now QOZs with no tax benefits. So again, you don't want the tax tail to chase the dog. You know, we don't rely on any tax benefits. We like the real estate on its own. The tax benefits, you know, are bonus. And that's how all QOZs and QOFs should be structured and have that mentality. Versus the partnerships of the 80s that just chased after tax benefits. You want the real estate to be successful in order to get the tax benefits that we'll discuss on the next slide. Again, bipartisan, Tim Scott, you know, there's a quote: to create a brighter tomorrow for communities that have been left behind, we need to capitalize on private sector resources that can help boost these areas in ways we haven't seen before. So again, developing multifamily or whatever type of real estate, the whole idea is development. You can't just invest into a multifamily, slap on new paint. It's almost all ground up construction. So you have to really improve the neighborhood in order to qualify as a QOF and receive tax benefits. So let's get into some of these tax considerations and timelines. This is more on the American Families Plan, which I'll get to in a bit. But real quickly, what I'm excited about Opportunity Zones is that it can help a wide net of situations. Again, it can be real estate, sale of a business. It could be concentrated stock or pool of stocks. It doesn't have to be the same dollar. So you can sell your Tesla stock and keep it in the brokerage account and take money from another bank account and invest into a QF. So it's very flexible. You can, compile gains, you lock in those gains, and you invest into a QOF for these tax benefits. But another piece to the advantage is that it can be owned in any type of ownership. So on the left, you'll see partnerships with a 1031, which we'll get into in a bit. Each partner has to decide if they want to do a 1031 exchange or not, and they all have to agree on the investment amount and the investment. With an opportunity zone, it goes down to the individual level. So each partner can decide if they want to invest into a QOF and what amount of their capital gains. So it's very, very
and there's no agent or intermediary involved that further complicates the deal, which is commonly associated with the 1031 exchanges. This doesn't require a third party.
Right. Exactly. So bottom line, it's very, very flexible on the investor side. The only rule really that the investor has is this 180-day rule. And what that states is, I sold my Tesla stock yesterday. I have 180 days from yesterday to invest into a QOF. Again, I could buy a boat with those proceeds and take money from another bank account. I just have to invest within 180 days in that window and close on that investment. With partnership gains, K1 gains, we'll discuss in a bit, but this webinar is very timely. So thank you, Brian, for getting me in front of some people that may be in a situation where they have K1 gains. Now that has extended timelines. They can realize, their gain and have that window within 180 days. But most with K1 gains start at the filing date of their partnership, which is March 15th, and that brings them to September 11th. So we'll get into that, but they have extra time, and basically by September 11th, if you have any K1 gains from all realized at any time in 2020, you still have a couple months to invest. But typically you have 180 days, 6 months from the day you realize that gain. If you're on a payment plan, it's whatever the CPA set up at the time. Typically they're realized in the year for that amount that they received compensation for. So tax benefits, we summarize it into 3 main buckets: defer, reduce, and eliminate. We call it the Dr. Dre of QOF investment. So I like taking a real estate example because it kind of hits all points and adds complexity. So let's say Mrs. Jones buys a duplex for $1 million. And whether it's a week later, 30 years later, she sells it for $2 million. So $1 million cost basis and a $1 million gain. She sells that real estate and gets to pocket her cost basis and put it in tax-free. She's now has $1 million gain that she's liable for to pay tax on, and she can invest all 1 million of her capital gains into a QF, or she could put 100,000 in it. So another flexible and I think attractive piece to QOFs is that it's not all or nothing. You put whatever portion you're comfortable with, shelving, locking in those gains, and in a tax efficient manner. So in my example, let's say she puts all 1 million in to make my life easy and my math easy. It's a small percentage of her overall net worth. So she puts all 1 million in to maximize her tax benefits. The first tax benefit she will realize is that instead of writing a check to Uncle Sam, instead of writing a check to Uncle Sam right now, she gets to defer that investment for up to 6 years. So at the end of 2026, payable in 2027. So she has all 1 million invested in a QOF that's buying up parking lots, a dilapidated motorcycle shop, and she has all 1 million working for her for, again, till the end of 2026, payable in 2027. Then when she does pay the tax in 2027, she pays it on 90% of her original gain. So instead of paying tax on $1 million today, she's paying tax on 900,000, 6 years later. Before I get into the largest potential tax benefit, are there any questions on defer and reduce? And you can also type in questions to Brian.
No, we're good.
Okay. So she deferred her tax, she reduced her tax by 10%. This goes away, this tax benefit goes away for new investors at the end of this year. So every year that goes by, the tax benefits for new QOF investors get small. But there will be more people taking advantage of this capital gain solution in 2026 with no deferral, no reduction, just for the elimination, because this is by far the biggest tax benefit. And
so real quick, question for you real quick. So after 2021, we're going to lose the ability to reduce, but we're still going to have the ability to defer.
Right. And I did get a question, what if the QOF has also appreciated? So that, thanks, Brad, that gets into this third tax benefit. So you do, yes, this goes away for new investors. So the only reason why this would be maybe a consideration, because in the overall 10+ year hold, this is the smallest tax benefit. But if your window includes December of this year and January of next year, you may want to invest in December to get that extra 10% reduction. But it's not the end of the world. When this goes away, the tax benefits will almost be as great, for investors next year. It's more about your timeline. It's not going to cause somebody to sell their company today versus next year or in 2 years. But if it lines up in somebody's timeline, they may want to invest in December versus in January. Most people have their own 180 days, and January or next year is not even an option. To Brad's point, so the largest tax benefit states that if Mrs. Jones, let's say, again, she's putting $1 million into a qualified opportunity zone fund that's buying really just pieces of dirt. And fast forward 3-4 years later, there are now 5 multifamily complexes that have tenants in place. They're cash flowing. There's a museum on the bottom, park around it. It's a physical structure. That real estate is hypothetically worth a lot more than it was a piece of dirt. So the elimination piece states that if Mrs. Jones invests in her QF and holds it for 10 years or longer, at the 10-year mark, all the growth on the QOF is tax-free. So all that appreciation that Brad was asking, it is tax-free. It's not considered a Roth, but I like to think of it as like a Roth IRA on steroids at year 10, because it's the same kind of concept. All of the growth is eliminated tax-wise, and it's compounding tax-free. So if you actually held those assets in the QOF till 2047 or sold in any time in between, all that growth is tax-free.
So I have a few questions, Matthew.
Yeah.
So first of all, about the, let's go back to the deferral real quick. So one of the things with the deferral, this is a common question, is so if capital gains tax are taxed at a less preferential rate than they are today, I'm going to be subject to those less preferential rates on capital gains tax when my taxes are ultimately due. And there's really nothing I can do about, obviously predicting or controlling that today. That's correct, right? So if I'm going to pay 15 or 20% today, which is a current capital gains, it's actually 0, 15, or 20, depending on where you fall. if for some reason in 2026, when these taxes are due, I'm in, capital gains tax for me is 30%, I'm going to be paying 30, right?
Right. You do take capital gains rate risk. In a couple slides, we're going to go over an example using a 39% hypothetical. It actually,
Okay.
the QOF benefits get greater because you have that all your money working for you for let's call it 6 years. Then you reduce
Sure.
it, so that should minimize or wipe away any cap gains risk.
Well,
But
okay.
let's say that didn't. You're also growing tax free. So if you're paying more in terms of percentages in 2026, if cap gains rates go up, but you're also paying more in 2031, 2032, 2033. But we quantify that change in a couple slides on a kind of side-by-side, apples to apples.
Gotcha. Okay. And then, so it's a similar conundrum to, should I put money in an IRA, right? Except this is a hypothetically or theoretically a shorter term time horizon IRA. You've got a, 6-year deferral period, and then you're going to pay taxes. Yeah,
basically, here's a solution to, if you have cap gains on it, almost anything, here's a solution: take some chips off the table in a tax efficient manner, defer for about 6 years, reduce it by 10%, and the biggest, grow tax free. You do have to pay that tax on the original gain at the end of 2026, payable in 2027. So you want to leave some of your gains. If it's, a sizable capital event, you want to make sure you plan on paying that tax down the road, and not putting all of your gains into a QF, because you have to, pay tax at the end of the day. We plan on doing a cash out refi by the end of 2026, where we go to a bank, and again, they're no longer parking lots, they're multifamily complexes with tenants and cash flow. We can go to the bank, it was approved by the IRS to do a cash out refi and return, let's say 40% of investor capital back tax free. So that is allowed in the QOZ program. It's our intent. It's the intent of many QOFs, but it's not guaranteed. So you just want to hold some funds aside and put it in the sinking fund to pay the tax down the road.
So I'm gonna keep asking some questions here. So I invest, I buy a duplex for $1 million, I sell it for $2 million. I've got $1 million capital gain, which today it would cost me $200,000 in capital gains tax. But I elect to put all that gain in this fund. I reduce my gain by 10%, or my tax liability by 10%, and defer it for 6 years. So, a few years down the road, I'm gonna have to pay it at a reduced amount. The rate, who knows? But when we get there, 6 years down the road, I would assume that, that dilapidated motorcycle shop that you bought, that you built a, multifamily apartment complex with some affordable living and some parks and maybe some mixed retail below, is going to be worth a lot more than what we paid for it. So as a sponsor, you guys do a cash out refinance, just like I would on my house that's appreciated over time. You take those proceeds, give them to the investors, which is tax free because it's a cash out refinance. It's not a sale of the asset. And then I can use that to offset my tax liability in 2026. So that's your plan. So theoretically, I wouldn't have to come out of pocket for the full amount, but it's still important, that I know where I'm going to access those funds when the time comes, if that doesn't occur. Exactly.
Plan for it. Okay. And plan for a cash out refi not happening. Plan to pay the tax, and then when a cash out refi does happen, now you have a good chunk of your principal back, and now you can invest in other, solutions that you have, Brian, that provide more liquidity and income than a
Gotcha. Okay. And then I'll just one more thing too that I'd like to chime in and say. I think that this is most relevant, at least to generate a conversation with someone that is experiencing a capital event. But I think that and that obviously is one of the more attractive parts of this out of the gate is that, man, I can defer a lot of taxes and not have to worry about it for a while. But I think the most impactful part of all of this is a tax-free growth. And I think that's what we have to realize is the tax-free growth is really the meat and potatoes of all of this. The deferment and everything's great. But that's something that I think is really should be in the spotlight is the elimination, of the appreciation for holding that for 10 years or longer down the line.
Exactly. Wouldn't you agree, Brian? It's not what you earn, it's what you keep.
Absolutely.
So like Brian said, you're deferring, reducing, and eliminating. And most QFs, once it's developed and the projects are stabilized, there will be cash flow. There'll be distributions. It all depends on when that QF releases those distributions to maximize the tax benefits. But this is meant for kind of a tax-free growth bucket. You want to consider it no income the first few years. It's more about the tax-free growth. But once these projects are developed and stabilized and they are producing distributions, that's when you'll see the big kick in the NAV, the net asset value price, and by a third party appraiser typically. And then it'll be just a normal standard cash flow, income producing property generating distributions. So just like any other multifamily or whatever real estate sector you invested. So
Matthew, let me stop you there. So in approximately year 3 or 4 or 5, things are developed, the property gets appraised. At that point, we've got tenants living in it, and those tenants are paying rent. And as an investor owner, I'm entitled to receive that, right? So
right.
Do you guys have a kind of a projected or pro forma rate? Like, what can I expect if I invest $1 million this, in 3 to 5 years down the road?
Yeah, most project a 5 to 8% distribution. Let's say 5% in year 5, just as an example. That 5% or distribution would have added tax benefits. Because it's new construction, you can take a lot of depreciation. So a lot of, let's say 80 to 90%, hypothetically, let's say is tax deferred. So most of the distributions you're getting, you can defer your tax and then consult the CPA. But at the 10-year mark, there's a step up in your basis to fair market value on everything. So even those distributions that most of it's tax deferred ultimately will be eliminated. So It will be a great use for, put income. It's just you don't want to rely on that portion or that bucket of your overall net worth for income, because again, it's going to take years for developments and to stabilize projects. But it's not a no distribution for 10 years kind of fund. We expect distributions, let's say at the end of 2026, most QOFs.
Gotcha. Okay.
So, yeah, and Brian, the next slide is going to have that doubling the cap gains rate example. But this, okay. I like this slide because it's apples to apples with all things being equal. So Mrs. Jones, again, let's say she sold her building, she has $1 million gain. This is using the national state tax average of 6.2. I realize most people are in Texas, so it won't be this high. Sure. But with apples to apples, just to quantify the tax benefits, Mrs. Jones has to pay 30%. So she really has $700,000 working for her. And let's say she earns at 8% a year for 10 years. She appreciates it. She has tax on that appreciation. She doesn't pay cap gains tax in 2027. She already paid her gains. And she's left with about 1.3. Or let's say she gets together with Brian, a fiduciary that talks about proactive solutions instead of just reactive services. And again, it's a small percentage of her overall net worth. She puts all 1 million in, she gets to defer it. She has all 1 million working for her for those 6 years, earning also an 8%. And this would be the lowest end projection of QOFs that I've seen out there. You know, ours is around the 10.4% projected IRR. But let's, again, apples to apples, 8%, which I think is also unfair to the QF, because what's doing 8% post-COVID, right? In a post-COVID world. But she has all 1 million working for her, compounding. She does have to pay her tax at the end of 2026, payable in 2027. That's a 270, but she's left with about 1.9 versus 1.3. So it's, the tax benefits are like a 4x increase over just paying your tax and having after-tax money working for you. Now, to Brian's point, what if, you know, in the American Families Plan, they are planning on a number of changes. Opportunity zones, again, bipartisan support. They were not mentioned in American Families Plan. Mostly 1031 exchanges are the mostly affected in the American Families Plan. But they are planning, the proposal is to increase long-term capital gains rate from 20 to 39.6 for households earning more than 1 million. So that is important because, again, like Brian said, you're paying tax in 2026 versus tax today. So let's look at that example where same example, $1 million investment. Mrs. Jones is paying now 39.6% tax. So she has 504,000 working for her, earning 8%. And she's grown that investment, and she does have to pay tax on that growth 10 years out. It's at 289. She's left with about 800K. Example B, Mrs. Jones puts all 1 million into a QF again, defers it, earns 8, has 1.158 working for her, grows it. She pays 446. So she's paying a lot more tax that Brian was speaking about. But at the end of the day, she's left with 1.7, and I wish they put them all next to each other. So I'm going to slide back and forth. So look at this. This is Mrs. Jones in the 39.6 environment. So her 1.3 turned to about 800K, and then doing the QOF, it was a 1.9 to a 1.7. So it affected QOFs, but it was 200K. With the after-tax money, it affected it a lot more. So it's counterintuitive, but as cap gains rates go up, the QOF potential tax benefits get even greater. It's just everybody's thinking of the 2026 and not the 2031 or the 2032 or 2033, all that tax-free growth. Because if cap gains increases, they're going to be also, you would assume they're higher in 2031 as well.
Sure.
So that's kind of, those two slides kind of quantify the tax benefits with everything being equal. You know, it's a reason.
You know, one thing that would, real quick, Matthew, one thing that would be interesting to see if you took one of those tables and applied a, you know, a 20% rate to it as opposed to 30 for those folks in Texas that, you know,
yeah,
today,
so there would
you know,
be
large capital gains 20.
Yeah, the tax benefits would be a little bit less. So instead of 4x, it's like 3.6, but we can actually run hypothetical models for anyone on what investment amount, what do they want the tax cap gains rate to be. You know, we have, we can run any hypothetical for someone, and we can email that to Brian.
Okay.
So the final regs, any other questions on the tax benefits?
No, not at the moment.
So the final regs came out in 2019. That's when we launched our fund. There was a lot more clarity. They now you have a number of QS raising money and deploying capital and developing ever since the final regs came out. But basically, and we've probably covered most of these, but the QOF is just a vehicle. It's a fund, Qualified Opportunity Zone Fund, for the real estate. You can also do QOZBs for businesses started in qualified opportunity zones. We don't partake in that. Real estate is our expertise and where most of the black and white regs are. So, but there are QOZBs out there. And again, the 180-day rule, no tracing requirement. That's again, doesn't have to be the same dollar. You can do anything you want with the money, and as long as you do it within 180 days. And then at least 63% of the business's assets have to be held in that actual property. And a QOF on the real estate side, 90% have to be qualified opportunity zone property. And then basically there's no sin businesses. So, you know, casinos, racetracks, golf courses, I don't know what they have against golf courses, but they can't be included in qualified opportunity zone funds. Some are focused on hotels only, some retail, storage. We focus only on multifamily and life science. We may have a retail portion where it's a bank on the bottom or a coffee shop on the corner, but we're focused mostly on multifamily. We believe that's where the demographics are. We can add an affordable living component to help the community and also get other, you know, city tax benefits. So there's a lot, to your earlier point, Brian, there's a lot that go into these developments. They're not just a typical development. You know, you have to adhere to rules and guidelines now and for the next 10, 12, 15 years.
Matthew, can you talk a little bit about the Life Science Center? What is a Life Science Center? Why do we need more? Who does it help? Who does it benefit? Yeah,
life sciences, that sector is a hot sector right now in real estate, especially with COVID, but even pre-COVID, there's been basically 0% vacancy in a lot of metro areas. What it is it's wet lab, purpose-built real estate. So it's for cancer research, pharmaceutical studies, you know, COVID testing centers. So it's all wet lab with their connected office space and data. So we have a life science project in our fund. It's in Philadelphia, but that focuses again on that wet lab metric. There's 0% vacancy in Philadelphia for life science. So again, with that building, it's 100% recyclable water. It has view glass to control temperature and sunlight. So it's a very energy efficient building. But most life sciences projects are purpose built right next to universities to help, you know, the professor and some students, you know, starting their own kind of research to large, you know, pharmaceutical studies that buy out smaller companies or need lab space.
Okay.
So yeah, we have that focus and multifamily in our QOFs. Again, evaluating the risk. These are development projects, so you want to deal with a developer that has extensive expertise, not in QOZs because they've been around since 2017, but just developments in general. You know, you're relying on the real estate, you're relying on that developer to develop a nice property on time, under budget. So you have development risk, illiquidity risk, again, 10+ year holds. But because of how flexible QOZs are on the onset, you know, you can put whatever portion you want to invest in a QF and lock up for 10 years growing tax free. The smart money is going to, you know, leave it in for more than 10 years because it's compounding, you know, if it's available to leave it. So yeah, you're taking risks. You just, again, want to deal with a large sponsor that has size, scale, that can cut costs, have low fees, you know, see off-market deals and projects. So there's a lot of advantages to going with a large firm, especially in qualified opportunity zones.
So can you talk a little bit about the fees, management fees? I mean, what are the costs to do business with you?
Yeah, with most qualified opportunity zones, the fees, there's going to be anywhere, if the advisor takes commission, it'll be a commission. There'll be an asset management fee, anywhere from, they could say 1.5 on equity and debt, or we've seen 1.75. We've seen 1.5 asset management fee, but they leave out, they're talking on just the equity, and then they double it. So you want to be fee conscious, and that's why you work with an advisor like Brian, who kind of takes apart the deals. There's usually a construction oversight fee, anywhere from 0.33 and higher. So a lot of PPMs, they allowed flexibility and not as much clarity. So with ours, we kind of lay it out, in black and white. So if you are interested and want to look at our fund, you can go through Brian and get an actual PPM, which is private placement memorandum, that will kind of dig into all the fees and all the risks, everything. But bottom line, there are some funds that have large loads, and then there's others that are kind of more transparent and have less fees, because you want, most of your money going into the ground working for you. Again, it's not chasing, tax benefits. You want the real estate to do well, and then, the tax benefits is just gravy. Oh, you also want to look for a cross promote if they have one, where basically some QOFs will have a hurdle rate, let's say 6%, where they have to perform and return 100% of the principal back, and a 6% a year from the time that it was held every year, in order for the sponsor to get a back end percentage. So that, I think, shows shareholder alignment. So that's another thing to consider. It's not just who has the less fees, it's who has their money and their interests aligned with the shareholders, who put $5 million in the ground to begin with, who has a reputation at stake. So there's a lot of risks to consider. And that's why it's good to go through a large fiduciary like Foundation Wealth that's good at taking part, private placements and private deals. On the tax reporting side, it's fairly easy. It's self-reporting. So there's two forms, 8949 and 8997. You file, I think, both when you do your initial investment, and then the form 8997, it reports all the QOF activity each year. So it's just some forms your accountant can handle that you send in with your tax return. So again, very easy on the investor side, a lot more complicated on the sponsor side. And then again, final regs came out in 2019. This is the 180-day window we talked about, but they added flexibility in the final regs for K1 partnership gains. Again, pass-through entities, S corps. So you can start your 180 days with the date the asset sold, but you have 3 options, and most K1 gains go with the 3 option because they have the most larger window to operate on, and that's starting 180 days from the date the partnership tax return is due, which again is March 15th, which brings them to September 11th. So it's over a 1.5 year look back on past gains. Even if you filed your tax return, paid the IRS, you can do an amendment, consult the CPA, and potentially get a portion back or credit. CPA can handle all that, but it's over a 1.5 year look back for realized gains. And just QOZs in general, in any type of ownership, if it's individually held, it's up to a 6-month look back. So you can plan for the capital event, but if you've had a capital event 4 months ago and you thought the only option is to pay all those taxes, you have 2 more months to invest into a QF with whatever portion you want to have the tax benefits for. It's not all or nothing. So real quick, Brian, I don't know how much time you want me to spend on this. This is just for real estate gains, 1031 exchanges.
Yeah. Yeah, I'd rather not. So I mean, I think you did a great job summing up, you know, the high points of the qualified opportunity zone. For me, you know, the biggest takeaways are, or I guess what I want you guys as folks listening to take away is number one, just how the deferral, the reduction, and the tax-free growth, how those components work together. And I think in that space, the biggest component is the tax-free growth. So I'd say that don't get caught up on, you know, hey, I'm going to do this to defer taxes. For me, the real opportunity is deferring actually, you know, tax-free growth for 10 years in the future. That's just huge. Opportunities like that don't come around very often. We all know how much, you know, we wish we would have put more in Roth IRAs years ago. And this is just another opportunity, another avenue really, to fund a tax-free vehicle that's not life insurance or something like that. You know, secondly, I think that it's important to take away is this is not an all or nothing deal. So as if we sell a business, a house, an appreciated stock portfolio, and let's just assume that we have, you know, $200,000 of capital gain, you know, you don't have to put it all into the opportunity zone fund. You could say, hey, look, you know, I'm gonna put $100,000 in this investment to diversify my portfolio, and take advantage of some tax-free growth. You know, so there's a lot of different options there. And I think an important third takeaway is that, you know, there's a lot of different sponsors out there like Cantor or Fitzgerald that participate in these opportunity zone fund investing. I've spent a lot of time talking to quite a few of them, and I'm really confident in Cantor. I like what they bring to the table. I like their background. It's a very, very respectable story. If you haven't heard the long version, feel free to let me know. I'm happy to share it with you. But they are a very philanthropic firm. They take care of their employees. They take care of their communities that they invest in. Their development partner, Silverstein, it's just a tremendous story. But I think as importantly, from a return perspective, in terms of like, can I depend on this to get to where I need it to be 10 years down the road? I feel confident in a firm like Cantor to get us there, as opposed to, you know, a lot of these others out there that, you know, who knows where they're going to be in 10 years. And so I think that that's just extremely important when committing, you know, an investment for a long period of time, is to go with somebody that really knows what they're doing, has a good story, has a good background, and has the wherewithal to get it done. So with that said, if anyone else, there's really not a whole lot of questions. We talked about a lot. I'm hoping that we did a good job answering a lot of them. But if anyone has any additional questions, feel free to shoot me an email. You could chime in below in the Q&A thing. But if you do have a question or something that you think about, you know, my email's Brian, or bcrukiel@foundationwealthpartners.com. You're more than welcome to email me, or info@foundationwealthpartners.com. And we'll get those questions answered. And also, if you'd like to set aside time to talk about your situation as it relates to, you know, capital gain, opportunity zone fund investing, I'm happy to discuss with you. I could even, you know, get with Matthew and bring him on a call or on a meeting individually as well. And or if there's anything else that you'd like to talk about. But I think this is something that's important, at the very least, to be aware of what it is. And with all that said, in closing, Matthew, is there anything else? Actually, just a second here. We do have a question. So how will the continuing education credits for this presentation, how are they going to be processed? And I'll let Matthew answer that one.
Yeah, just get Brian your name, and we can create a CE certificate, and we'll email Brian everything.
Perfect. Easy enough. I'm going to leave this up for a second. Are there any other questions or any other thoughts that you guys like to talk about while we're all together today? All right. Well, if there's another one that pops up, we'll make sure to get to it between now and then. But Matthew, is there any other closing statements or things that you'd like to share before we hop off?
No, I couldn't have said it better, Brian. Again, you're in good hands with Brian, whether you do an OZ or not. You know, just somebody who's taken that extra time and care and estate planning to a whole nother level. You know, you're in good hands with Foundation Wealth. And if, like Brian said, if any questions pop up, if you want to review a PPM on a specific QOF, I'm sure Brian can get you those PPMs on whatever fund you're looking at. But yeah, it's great to know about all your options, you know, instead of just paying the taxes. At least knowing about all of your options before it's too late. So I appreciate Brian setting this up and your time and everybody's time this Monday afternoon.
You got it. Well, thank you guys. And with that said, we'll talk to you soon. Wait, actually, before we go, one more question. So Matthew, real quick, with regard to the qualified opportunity zone funds that Cantor is participating in as a sponsor, how many different funds do you offer?
We have one flagship QOF that's closing at the end of this year. And we may have a new one after that, but as of now, that's our only large flagship QF. And then we have sidecars one at a time every 1 to 3 months. So at the end of the day, we probably have 3-4 sidecar, one project QF, and then our large flagship QF.
Gotcha. And so if you'd like to talk about any of the sidecars, or just want to see what they look like as they are released, let me know that that's something you're interested in, and I can send those out to you as they become accessible. But other than that, the difference is, just to reiterate, sidecar fund is going to be something that's more of a single project. It might be a multifamily building here with the Life Science Center below or something like that, in a single location, just one project, right? Whereas the flagship fund is going to have 3 to 5 projects in it. So you're going to be a little bit more diversified in the flagship fund. You're going to have access and exposure to a few different projects, all of which we can go visit and see. We can talk about like where they're located and what the plans are and everything. But in terms of the sidecar funds, those are going to be one project fund. So both options, have some great features, and there's reasons to do both, and reasons, to do one over the other, and an argument both ways. And so if that's something that you guys would like to discuss, please let me know. I'm happy to talk to you about it one-off, and then I'll show you some of the different options that Cantor has now, or that they'll have shortly in the future. And then I think that's about it, Matthew. So
Great.
Guys, thank you so much, and look forward to talking with you soon. Y'all take care. Bye-bye.